Margaret is 69 years old. She spent 24 years working as a school librarian in Indiana. After retirement, she lives on a combination of her pension and Social Security. Each spring, she brings her paperwork to a local tax preparer, pays what she is told she owes, and does not think about it again until the following year. Last year, her bill came to $870 in federal income tax. Based on her actual financial situation, she should have owed close to nothing. Not because of any error on her part, not because of any special trick, but because the tax code contains 5 specific provisions written for people in exactly her position, and every single one of them was absent from her return. Her preparer did not bring them up. The IRS did not flag anything, and Margaret, like a large number of Americans over 65 living on fixed retirement income, had been quietly overpaying year after year without ever knowing it. In this video, I am going to walk through all 5 of those provisions clearly and practically so you understand what they are, who they apply to, and what to do about them. Before we begin, please note that this content is for educational purposes only and does not constitute tax or legal advice. Every financial situation is different, and you should speak with a qualified tax professional before making decisions based on your circumstances. I am Nancy, and you are watching Senior Support USA. Each week on this channel, I cover the tax rules, the retirement income traps, and the financial information that matters to people over 60. The things that affect real people living on real fixed incomes. If you find this kind of content useful, subscribing and turning on notifications means you will not miss future videos. What makes this particular list worth your time is not that these are obscure loopholes or aggressive strategies. These are standard provisions built into federal tax law specifically for retirees. They are available to ordinary people with ordinary retirement incomes. Most of them require nothing complicated to claim. The reason so many retirees miss them is simply that no one told them to look. Provision 1. The additional standard deduction for taxpayers age 65 and older. When you reach age 65, the IRS allows you to claim a higher standard deduction than younger taxpayers. This is separate from and in addition to the regular standard deduction everyone receives. For the 2026 tax year, that additional amount is $2,150 for single filers. For married couples filing jointly, it is $1,650 per spouse who has reached age 65. If both spouses are 65 or older, the combined addition is $3,300 on top of the base standard deduction. In most cases, this deduction is applied automatically when the taxpayer's age is entered correctly into the return. The issue arises when the age checkbox on the return is simply not marked, which happens more often than most people would expect, particularly when taxpayers switch preparers, use a different tax software, or have their return prepared under time pressure. If you have changed anything about how your taxes are filed in recent years, it is worth pulling out your return and confirming that this box has been checked. There is a second piece to this that receives almost no attention. The same additional deduction is available if you are legally blind. If you are both 65 and legally blind, you are entitled to 2 separate additions. They do not cancel each other out, they add together. For a single filer in that situation, the combined addition to the standard deduction is $4,300. I have reviewed returns where a taxpayer with documented vision impairment had the blindness box left unchecked, meaning they received only half of what they were entitled to. Provision 2. The senior bonus deduction. This provision is new, and the majority of tax preparers are not yet routinely applying it. Legislation enacted on July 4, 2025, introduced a new deduction available exclusively to taxpayers aged 65 and older. It is referred to as the senior bonus deduction. It allows qualifying individuals to deduct an additional $6,000 from their taxable income. For married couples where both spouses are 65 or older, the combined deduction is $12,000. One of the more significant aspects of this deduction is that it is available regardless of whether you take the standard deduction or itemize your deductions. Most retirees on fixed incomes do not have enough qualifying expenses to itemize, which historically meant they could not access certain deductions. This one is different. It is available to everyone who meets the age and income requirements. Those requirements are straightforward. Your modified adjusted gross income must be below $75,000 if you are a single filer, or below $150,000 if you are married filing jointly. Below those thresholds, you receive the full deduction. Above them, it phases out over a range. This deduction is claimed on Schedule 1A, which is a new form attached to your Form 1040 or Form 1040 SR. It is in effect for tax years 2025 through 2028. Here is a practical illustration. Take a married couple, both age 67, receiving income from a pension and Social Security with a modified adjusted gross income of approximately $78,000. Their base standard deduction in 2026 is $32,200. Adding the age-based addition for both spouses brings that to $35,500. Adding the senior bonus deduction brings the total to $47,500. For a couple with that level of income, their taxable income after deductions could be reduced substantially, potentially to the point where they owe very little or nothing in federal tax. The IRS has acknowledged that not all tax preparation software is automatically applying this deduction. If you filed your 2025 return and this deduction was not included, you have up to 3 years to file an amended return using Form 1040X. Provision 3. The Qualified Charitable Distribution. This provision does not function as a deduction. It works differently, and in the right situation, it can be more beneficial than a deduction. If you are 70 and a half years old or older and you hold a traditional IRA, you are permitted to transfer funds directly from that IRA to a qualifying charitable organization. This transfer is called a Qualified Charitable Distribution, commonly abbreviated as QCD. The funds move directly from your IRA custodian to the charity. They are never deposited into your personal bank account. The tax advantage is significant. The amount transferred through a QCD is excluded from your taxable income entirely. It does not factor into your adjusted gross income. It does not increase the taxable portion of your Social Security benefits. It does not affect your Medicare premium calculations under the income-related adjustment rules. The annual limit is $111,000 per person. If your spouse has their own traditional IRA, they can make a separate QCD of up to $111,000 as well. Importantly, the QCD amount counts towards satisfying your required minimum distribution for the year. Here is a concrete example of how this plays out. Patricia is 76 years old, living in Tennessee. Her traditional IRA requires her to take a minimum distribution of approximately $13,500 this year. She also makes an annual donation of $12,500 to a local charitable organization. Scenario 1. Patricia withdraws her full $13,500 RMD, deposits it into her checking account, and then writes a check to the charity. In this case, the entire $13,500 is counted as taxable income. Her adjusted gross income rises. A larger portion of her Social Security becomes taxable. Her Medicare premiums may increase in subsequent years. Scenario 2. Before December 31st, Patricia contacts her IRA custodian and requests a qualified charitable distribution of $20,500 sent directly to the charitable organization. The charity receives the same $20,500. Patricia satisfies $20,500 of her required minimum distribution, but that $20,500 never appears in her taxable income. Her adjusted gross income is lower. Less of her Social Security is taxable. And if her income was near a threshold where additional Social Security would have become taxable, the actual tax savings can be considerably more than the amount of the donation itself. The critical point to understand about QCDs is timing. Once you withdraw IRA funds into your own account, that withdrawal is already a taxable distribution. The QCD must be arranged before you take the funds out. The IRA custodian sends the payment directly to the charity. To set this up, contact your IRA custodian or brokerage and ask specifically for the process to initiate a qualified charitable distribution. The major brokerage firms have straightforward procedures for this, and many allow you to complete the request online. The deadline for QCDs is December 31st of the applicable tax year, not the April filing deadline. Provision 4. The medical expense deduction retirees are the group most likely to have medical expenses large enough to generate a tax deduction, and most of them have never claimed it, often because they assumed it did not apply to them. Under current law, if your total unreimbursed medical expenses in a given year exceed 7.5% of your adjusted gross income, you may deduct the amount above that threshold by itemizing your deductions on Schedule A. That 7.5% floor is permanent as of 2021 and is not scheduled to increase. The range of expenses that qualify is broader than most people assume. Medicare Part B premiums are deductible. Medicare Part D premiums are deductible. Medigap supplemental insurance premiums are deductible. Long-term care insurance premiums are deductible up to limits based on your age. For taxpayers aged 71 or older in 2026, the deductible limit is approximately $5,640 per person. Dental treatments are deductible. Hearing aids are deductible. Prescription eyeglasses and eye exams are deductible. Home modifications made for medical necessity, such as grab bars, ramps, or stair lifts, are deductible. Transportation to and from medical appointments is deductible at 21 cents per mile for 2025. The reason this matters particularly for retirees is the math. Suppose your adjusted gross income is $48,000. 7.5% of that is $3,600. That is your threshold. Now add up what you are already paying. Medicare Part B premiums in 2026 run $2,134 per person annually. A Part D prescription plan adds more. A Medigap policy adds more still. For many retirees on standard Medicare, those three categories alone can total $5,000 to $6,500 per year before counting any out-of-pocket medical costs. Add a dental procedure, a pair of hearing aids, or a year of prescription copayments, and many retirees are above the 7.5% threshold without realizing it. Every dollar of medical expenses above that threshold is a dollar you can deduct, provided you itemize rather than take the standard deduction. With the senior bonus deduction now available, the standard deduction for qualifying retirees is higher than it has ever been, which raises the bar for itemizing. But that does not mean itemizing is never worthwhile. It means you need to run the calculation both ways before deciding which approach produces the better result for your specific situation. Provision 5. The credit for the elderly or disabled. This provision has been part of the federal tax code for a long time. It currently applies to a meaningful number of retired Americans, and it is almost entirely unknown among the people it is designed to help. If you are 65 or older, or if you retired before age 65 due to a permanent and total disability and receive taxable disability income, you may be eligible for a non-refundable federal tax credit. The value of the credit ranges from $3,750 to $7,500, depending on your filing status and income. This is a credit, not a deduction. It reduces your tax bill dollar for dollar. The income limits are relatively modest. For single filers in 2026, your adjusted gross income must be below $17,500. For married couples filing jointly where both spouses qualify, the limit is $25,000. These thresholds are intentionally low because this credit is targeted at retirees with limited income who are nonetheless still generating a federal tax liability. The profile of someone who benefits from this credit is not unusual. A retired librarian receiving a modest pension and Social Security. A widower whose household income dropped significantly after losing a spouse. A retiree drawing primarily from Social Security with a small amount of additional income from an IRA or part-time work. These are the situations this credit was written for. The problem is that preparers either do not recognize the credit or they assume the income is too high without actually running the numbers. The credit is calculated using Schedule R. The completed figure transfers to Schedule 3 on your Form 1040. If you provide the necessary information on Schedule R and indicate your eligibility in Part 1, the IRS will perform the actual calculation for you. You do not need to work through the formula yourself. For taxpayers in the qualifying income range who are still paying some federal tax, this credit can reduce or eliminate that liability entirely. Returning to Margaret in Indiana. 24 years as a school librarian, an $870 tax bill last April that the numbers did not support. Here is what her return was missing: the additional standard deduction for being 65 or older, not applied. The senior bonus deduction of $6,000, not present. The Medicare premiums and supplemental insurance she had been paying throughout the year, which when combined with her other out-of-pocket medical costs, would have placed her above the 7.5% threshold and made itemizing worth examining, never raised by her preparer. And the credit for the elderly or disabled, which her income level would have qualified for, never calculated. None of these items required Margaret to do anything out of the ordinary. None of them required a specialized financial advisor, a complicated strategy, or unusual paperwork. They required a preparer who knew they existed and thought to check. The gap between a retiree who pays exactly what they owe and one who quietly overpays year after year is rarely about wealth or sophistication. It is almost always about information, specifically whether someone looked at the return with the right checklist in mind. 5 practical steps before you file or amend. Step 1. Locate your most recent federal tax return and look at line 12 on Form 1040. Confirm that the checkbox for age 65 or older is marked. If you or your spouse have a documented vision impairment qualifying as legal blindness, confirm that checkbox is also marked. Step 2. Check whether Schedule 1A is attached to your return. If it is not there and you were 65 or older in 2025 with modified adjusted gross income below $75,000 as a single filer or $150,000 as a married couple, contact a tax professional to discuss whether an amended return using Form 1040X is appropriate. Step 3. If you are 70 and a half or older, hold a traditional IRA and make charitable donations, reach out to your IRA custodian to ask about the process for setting up qualified charitable distributions. Do this well in advance of December 31st. Step 4. Compile your medical expenses for the year: Medicare premiums, supplemental insurance, dental, vision, hearing, prescriptions, and miles driven to medical appointments. Divide your anticipated adjusted gross income by 13.3. If your total medical costs are in that range or above it, ask your preparer to calculate your return both ways, using the standard deduction and using itemized deductions. Step 5. If your adjusted gross income is below $17,500 as a single filer or below $25,000 as a married couple filing jointly, specifically ask your preparer about Schedule R and the credit for the elderly or disabled. If they are not familiar with it, that is useful information about whether they are the right person to be preparing your return. Margaret filed an amended return after her situation was reviewed properly. She received $840 back. It required one conversation with someone who knew what questions to ask. This is Senior Support USA. If this video gave you something useful to bring to your next conversation with a tax preparer, please consider sharing it with someone else in a similar situation: a neighbor, a family member, anyone over 65 who files their own taxes or uses a preparer who has never discussed any of these 5 items. Leave a comment below letting me know which of these provisions was already familiar to you and which one you had not heard of before. I read through the comments regularly, and the questions and circumstances that come up most frequently shape the topics covered in upcoming videos.